So let's look at the first asymmetric information problem. And this problem is facing all the financial intermediaries. As I said, we see the good side about financial intermediary. It's great, we have a lot, but they also facing the problem, but they have to solve it. So one of the big problem is the information cost, and one of the information costs is called adverse selection. So adverse selection happened before transaction happened. So adverse selection will occur before transaction happened. So let's look at what is adverse selection and who find this adverse selection. So in order to explain what is adverse selection, I have to mention about this Nobel Prize winner, George Akerlof. So he's the Nobel Prize winner in economic science in 2001. And actually, I have an interesting story about talking about him. And hopefully, it's a story can motivate you to working hard. So this is paper that allow him to win the Nobel Prize actually got rejected many times by the top journals. And then he never gave up, and he published in a not top tier journal actually. And then eventually people realized, wait a second, he really finds something special. And when people pull him out, and people just make it as a encouraging story. So when you got rejected many times, but if you are perseverant, and if you truly know what you are doing is right, and karma is real. So let's talk about what kind of theory he invented. So the theory is called the lemon theory. What you're gonna say? What is it related to lemon? So if you are the person know about secondhand car market, and you should have heard about lemon and peach. So for the secondhand car, if the secondhand car is great, secondhand car no problem and perfect shape, and the previous owner loved it to death, and they just think about to switch to a better car and they sell it, but that car with a good quality is called peach. And so it tastes sweet and it looks pretty. And but another type opposite situation is the owner might beat up the car and they know the car had a huge problem, but when they try to sell it, they just don't try to reveal the information. And so when you buy it, when you bought it, there are tons of parma come out. So maybe on a $3,000 you bought it, you spent $5,000 to fix it. So basically, it's worthless, right? So in this situation, where you got this kind of bad quality secondhand car, and you feel tastes very sour. So that's why they call it sour car and a peach car. So how this theory relates to the adverse selection. So think about on the secondhand market. Just imagine there is no regulator. So the only thing you know is you go to the market to buy a secondhand vehicle. So they all can look pretty because they can polish it and repaint it. But for the car, the mechanic part, sometimes you won't be able to see it until you drive for 1 or 2, 3 weeks. So what happened for this market is it's mixed product. So some product is peach, some product is lemon. So how the market is going to pricing the car? So they usually pricing based on the average. So let's see, the lemon car only worth, we just use a very unrealistic price because we just try to make the math calculation easier. So let's see, the lemon car is really cheap. It's only worth $50. I know it's never happened. Just think about $50. And the peach car, the same, look exactly the same model, but the difference is the owner take care of it. So the peach car, the value should be $100. So when you go to the secondhand market, before you purchase the car, what you see is two exactly the same car. So how the car seller pricing the cars? They use the market average price. So 50, 100, so average will be 75, right? 75. So that will become the market price for this car because they look exactly the same. The difference is the seller have hiding information because seller can say, I really take care of the car, but they actually didn't. And the seller who really take care of the car say, I really take care of the car, but you might not believe it. So that's why the price end up $75. So if you go to the market, you buy, you see $75. It's literally based on your luck. And you bought $75, maybe that's a peach, you're happy, and maybe it's a lemon, you feel sad. But from seller's standpoint of view, so you will notice that the who are selling a peach car, they actually lose $25. But whoever's selling the lemon car, they actually gain $25. So if you look at this dynamic process, as time passed by, the Originally, the market mixed the peach car, the red car is peach car with the lemon car. But as time goes by, you can see that the peach seller never gain any money. They lose $25, but the lemon car keep making money, $25. And so then the peach car will start to disappear from the market. So the only thing left will be the lemon car. So you can see this dynamic process. So this is called adverse selection. Why is it called the asymmetric information? Because the seller had more information than the buyer. And so the why is called adverse selection instead of moral hazard, because this asymmetric information happened before transaction happened, right? Occurred. Because before you purchase it, this asymmetric information exists. After you purchase this car, this asymmetric is no longer there because you're actually going to be able to figure out whether this is a lemon or peach car. So that's why this is called adverse selection. So the bad car get rid of the good car. It is because the information is not transparent. Only the seller had information, and then the bad seller had the intention to hiding the problem to mess up the market. So this is called adverse selection. How this adverse selection implement on the financial market? So we're going to look at the two different markets. So stock market and the bond market. So for the stock market, and so the firm who have who are so the implication of this adverse selection or Lemon's theory to the financial market is pretty straightforward. So on the both stock and bond market, so if there is no agent to reveal the information, what happens is the bad firm are the one usually likely to sell the stock to you and acquire the fund from you. Because what happens is if you have no idea how this firm running, you don't know the manager, you don't know if they're good. So they are really good at talking about their company. They are great, excellent, but nobody review their performance. The only thing you go is, okay, this is a good firm, this is a good firm. But the truly good firm and worth more value than the firm bad, but just talking about they're good. So what happens on the market price, they will only sell the market price. And then for you, you are facing the dilemma is if you pay the average price and if you end up a good firm, you're lucky. If you end up a bad firm, you are bad luck. However, from firm's perspective, so the good company is undervalued and the bad company is overvalued. So the good company feel, oh, what's the problem for me? I undervalue. It's not really worth it for me to issue this security or issue this debt instrument. And then they just give up because they are keep losing money by offering the stock or selling their bond. But for the bad company, it's opposite situation, and so they are more likely to issue the bond and sell the security to you. So in the long term, what happens is no good company want to sell in the stock and issue the bond. Only the bad company want to do it. So obviously you said it never happened. You're right because like I said, we have a healthy, effective financial market. And so we already foresee this problem facing the investors. And so that's why we have a policy to targeting the adverse selection. So that's why we're going to look at how we're going to So that's why we're going to look at how we're going to solve the problem. But before we look at that, we have to look at the fundamental reason behind this fact we see. So if the quality cannot be assessed, the buyer is willing to pay at most a price that reflects the average quality, and the seller of the good quality item will not want to sell at a price for the average quality. So the buyer will decide not to buy at all because all that is left in the market is poorly quality items. So this explains the fact 2 and partially explain the fact 1. So remember when we mentioned about US, the 8 facts. So the facts number 2. So fact number 2 talk about issuing the marketable debt and equity security is not the primary way in which business finance their operation, because as we talk about direct finance, the problem we're facing here is called adverse selection. You have to actually just based on you by being an individual investor, you have fewer information to understand if the corporation is good or bad. So that's why fewer business can really raise funds through the debt directly direct finance. And the two, indirect finance is many times more important than the direct finance. So that's why people, if they cannot use the direct finance, that's why they have to rely on the indirect finance. So, like I said, how are we going to solve this adverse selection problem? And we're going to go back to look at our effective financial structure. Look at US, look at Germany, look at Japan. Is there any solution they came up? The answer is yes. So now let's look at what would be the possible solution for the adverse selection. So the first method is called a private production and the sale of the information. So I'm sure everybody heard about S&P. I know you guys heard S&P index or 5,000 index, 500 index. And so that is S&P actually is a company, and it's a consulting, like a price agent. And also usually they are the one offering the information to the financial market participant. And Moody's, they are rating the companies. We look at it in the previous chapter, and a value line. So they are all the private sectors, private companies. They are doing a lot of market study to review the corporation, whether they are good company or bad company. Because if you think about adverse selection, the main problem is before you purchasing the stock, before you purchasing the debt instrument, so the seller, which is the company, the business, has more information than you. So in order to help you to make a better decision or to avoid adverse selection happening, so those private company can offer information to let you know how good this company is, and then you can make a decision whether you want to lend your money to them or whether you want to be buying their stocks. So what's the problem? So the problem here is if you really try to Google what is a Moody index, and you will notice that some forum they might already post it. So why is that? Because although they charge people for the information they collected, so they're charging their client, but the client can, first of all, their employee can share on some forum. So we're going to generate some free rider, which means people will be able to share information they found without paying it. And also some big company, if they want to really save, a small company, if they really want to save the money to buy the services from S&P or Moody's, so what they can do is they look at the big fish on the market to see how they perform. They can just follow their decision to make their decision. So what's the problem here? We call it free rider, which means the company without paying, they still can enjoy the information they reveal. And so the big company will eventually say, wait a second, why I have to be the ones who pay the money to get the information, and then have a bunch of competitors can just use my action as an indicator to take their action. So eventually the big company won't want to buy it as well, right? So that's why we have to have the supplement method besides the private product. So the government also jump into offering more information. So we have the government regulation to increase increase information before the transaction happen. So the government agent, including the Security Exchange and the Commission, and so Security Exchange and the Commission, so they set the rules, highly regulated market. So that's why look at this solution, answer the question, the fact number 5 we see in the previous video, the fifth fact about the financial structure. So the financial system is among the most heavily regulated sector of the economy. So this is the fifth fact. However, one thing you have to pay attention is not all this government regulation using government policies not always works well to solve the adverse selection problem, because keep in mind, one big joint government and deal with so many small business, they don't have that much power to do it. So what is another solution? And actually, next solution will be relatively much better than the first and the second solution. That is rely on the financial intermediary, like financial commercial banks, the insurance company, etc. We rely on the financial intermediation. So why they will be why they can work better than the government? Like I said, they can meet the economies of the scale, and also they will have that wealth to hire the expert to help them to figure out finding the information to help the investor to make a better decision. And so that's why this third solution explain the facts with 3, 4, and 6. So let's look So the last method we're going to look at it in terms of how to solving this adverse selection problem is using the collaterals and or the net worth. So the net worth is the ratio between asset liability. But first of all, let's explain what is the collaterals. So for instance, if you try to um, if you try to have a mortgage, so if you buy a $250,000 houses, and the reason the bank will be able to lend the money to you if is because you are using your house as a collateral. So which means if you cannot pay the money back, so they can own your house and sell your house. But usually the bank doesn't want to do it because you know that selling the house is not easy things. Usually take months to sell it. So that's why when you try to get a mortgage from the bank, they also not only just measure the value of the house, but also they want to look at your incomes and do you have any other debts, and also look at your credit scores. And so you can see having the collaterals, it will help to avoid adverse selection, because if by chance you bought a stock from the poor company, or you lending the money to the company, they might not be able to pay it back, but they had a collateral, so you can eventually own that asset that you used to as a collateral. You can sell it, so that will help you to reduce your loss. So that's why the collateral, the importance of the collateral on reducing the adverse selection explained the fact number 7 we see in the previous slides. So let's look at what is. So the fact 7, collateral is a prevent feature of the debt contracts for both household and businesses. And so the collateral is very important because it helps us to reducing the potential risk to have the adverse selection. So in next video we're going to look at is the moral hazard. When we look at moral hazard, we're going to introduce a very famous economic concept called the principal agent problem.